start again for my benefit. Dan from Boundary Capital, Paul from Par Equity, Martin Fox from the EIS Association, and Gordon from Blackfinch. Thank you for sticking with us. I hope you enjoyed that little segment. Now we're going to look more to the future for this season's tax efficient investing. We've kind of looked a little bit about sort of part of the past. I mean, Paul, I'll start with you. One of the memorable segments from the last series was George Freeman, the Conservative MP, getting very excited about this current government supporting sort of startups. We'll try and keep this discussion non-partisan, but more importantly, looking forward. Are there obvious suggestions that any major parties should be looking to do to support this part of the economy and obviously specifically the tax efficient industry?
I think the short answer to that has to be yes. And I think there is the good news is there's a general acceptance of that, I think, from all the main players. What we need to do is drive growth, and the area that's going to create employment and value and play to the strengths of the UK economy, which is absolutely a knowledge-based economy, is to get more startups and more growth companies achieving their potential. So it's not just getting them to start, it's how do you support them through to a scale which is useful and valuable. And I think that will play out. I mean, I'm hopeful of that. The messages we're hearing from HMRC and Treasury and some of the politicians as individuals is that they see that coming.
Martin, I guess the EIS Association, particularly your Director General Mark Brownridge, is sort of engaging quite actively on these areas?
Very much so. Paul touched on a word, scale. Scale-ups is a new buzzword.
Yeah.
In the European League of countries, the UK is very good at starting up businesses. It's not so good, it's way down in terms of scaling up into major businesses. And the government's concerned about that. They've been looking at it, and I think we will see more developments to encourage scale-up, as they call it. And if you do read the 256-page document, which is the UK industrial strategy that came out from the government earlier this year, small and scale-up businesses are a key part of their plans for the future.
And Dan, I guess part of it is, though, for politicians not to fiddle too much with the rules, because it's a sort of general bugbear, isn't it, that just as you all as providers and the advisor community get used to a scenario and they start creating sort of consistent outcomes for clients, somebody comes along with a brainwave as to how to change things. So, stick with the rules, maybe?
Yeah, I think there is an element of that, and everyone gets very excited in both senses of the word about legislation. If we look at the big picture, the UK economy invests in technology business. I mean, certainly I know there's lots of other EIS sectors. Obviously, some of the fastest growing are business services and technology, and obviously that's what the three of us are involved with to some extent.
We're only about a quarter of a mile from the famous Silicon Roundabout in the centre of London, aren't we?
Right, but if we put it in perspective, the UK in Europe is £3 billion worth of investment was invested in technology companies in 2017, and I think that the next biggest country in Europe was sixth of the size of that, which was Germany, which was 700 million pounds. So, and then it goes down from there. So if you put it all in perspective, the amount and the difference and the uniqueness of the UK, regardless of Brexit and this and that and the other, and no one really is going to mess with that in a big picture certainly without severe consequences. So yeah, sticking and obviously don't fiddle too much, but there's just a very, very rich tradition of, and the point about scale-ups is still very, very valid and a very big one, but notwithstanding that, the amount of investment, the amount of investors, tax efficient and non, skill, because successful entrepreneurs bring money and experience back to the economy, and then that permeates to the man in the street. And actually other European companies set up in the UK to get the tax relief, they rebase. This is a very common thing, and I'm sure we've all invested in this kind of situation. It does not happen the other way around. Apart from very specific circumstances, like where there might be a very specific customer base abroad or something like that. So, putting all that in perspective, there are some industries which are there and they're never going to go away.
So that sort of almost raises the spectre of Brexit. I don't know who wants to sort of pick up on this. I mean, does anybody feel the Brexit issue, the March deadline, is going to make any difference to the way you're all investing, sort of looking forward? I mean, Paul?
I don't think it has had any impact to date.
Yeah.
I think the media are quite obsessed with it, and
We are.
politicians are.
Yes.
I think the business community is just getting on with it. I think there is a bit of concern around some of the incoming talent and the issue that might have in terms of people, the entrepreneurs and the technology skill.
And you presumably find that with some of the tech businesses you invest in, certainly the ones I talk to in and around this part of London, that's their issue.
That I think is probably the number one concern that we hear about and that we talk about. I think that the general economy, the availability of money, the desire to keep developing this sector is, I think, will be untouched.
So keep calm.
But talent's the question mark.
Yeah. Keep calm and carry on investing then.
Absolutely.
Right, that's the end of Brexit. Let's kind of, I mean, one of the areas that we need to talk about is inheritance tax. I mean, it's a big part of how the advisor community sort of uses this. We're in the middle of a much broader inheritance tax review that the government's sort of putting into place. Any sort of thoughts that come out, Gordon?
Well, it's quite interesting, really. The whole premise of this inheritance tax review really was to simplify things, and it's across the board. So we'll obviously be talking about business relief, but formerly business property relief, because that's the side of the business that we're in. But also, we saw just a week or so ago the Court of Protection, some of the applications that go through there. We actually saw a case go to the High Court, and actually money was being able to be given away from a donor's estate, which, although it's just a nil rate band, was still something that's quite new. So I don't know where the emphasis of it going to be. There's quite a lot of rumours whether there might be some constraints around AIM companies. If you take a historic view, business relief has only ever been expanded. It was for private limited companies, and the advent of AIM coming about in 1995, the legislation was extended to AIM. In 2013, we had the advent of ISAs being able to hold AIM stocks, which they were before, but also to have the IHT benefits. So I think it's an area that the government are quite happy with, because remember, every time that we put £1 into these investments, it's likely to go around the economy 3 to 5 times. So although someone as an individual might be getting inheritance tax saving, the value for the government, the receipts that they're receiving from corporation tax, from income tax, national insurance contributions, and then the follow-on supporting industries from that particular business is quite impressive and substantial, which people shouldn't really forget about.
So many advisors are beginning to sit down now with clients who might have sort of tax events potentially about to happen. What would be the sort of guidance that you would be kind of giving? There's a little bit of uncertainty. I don't want to overplay this, but it's for the advisor community. It's about making sure something they do now doesn't sort of fall outside the rules going forward.
Exactly. The main issue with that, if there's a change in legislation, is that then there might be a run on particular companies, and so liquidity might be an issue. So again, we can only plan on today's legislation. So you could wait and see what happens, and if you're this close to the budget, it might be a sensible thing to do.
Yeah.
However, if you do have good liquidity and if you spread your investments around a number of different strategies, business relief is a great one, but also, if possible, also use some type of life policies, trust, gifts. It depends obviously on personal circumstance, but overall it's a very robust industry. And there are ways to actually mitigate those particular risks as well by having a decent spread of underlying.
So again, as an advisor, this is a brilliant way of demonstrating the value, how you earn your fee with your client, isn't it?
Definitely. Of course, there's different routes to inheritance tax planning, and depending on whether you've got your solicitor's hat on or whether you've got an advisor's hat on, one is better than the other. But the flexibility of business relief and what it can offer for clients is pretty much second to none. You keep access to your capital, and that's probably the most important thing. Secondly to that, it used to be the case that the 2-year time frame was the most attractive thing. We're still seeing the same demographic of clients coming through the door, but as the reason for investing in business relief used to be the 2-year clock, now the feedback that we get from advisors is more that their clients want to retain access to the capital because of advances in medical care. They might last longer, they might live longer rather.
And they don't want to give all the money away to the kids.
Exactly. It depends. It depends on their circumstances. But you know, as a family, you know, we've looked at this sort of thing, and you know, when it came to my gran, we were deciding whether to have her cremated or whether actually to bury her. But you know, in the end, we decided to let her live.
And it's good to know she's still with us.
Yes.
Let's talk about this kind of issue, Martin, of qualifying AIM-listed companies that are often sort of wrapped into some of the IHT solutions. It seems nuts to me that I can't just go somewhere onto the London Stock Exchange and see a list of businesses that go, that one qualifies, that one doesn't. That's difficult for advisors, isn't it? It's difficult for fund managers, actually.
I can only agree.
Okay, that's not a very useful answer.
I do appreciate that, but no, you're absolutely right. Fund managers can spend an awful lot of time just trying to get clarity as to does this company qualify or not. And when you've got, I guess, 70% of AIM stocks, I think it's about that qualify for BR and the rest don't, it can be very hard for them.
So advice would be what sort of, take your time as an advisor, kind of understand a bit more about it, deal with fund managers who have got good experience in this space?
I would deal with fund managers that actually have done the homework, absolutely. Yes.
And I was about to call you Gordon again. You see, this is the subliminal nature of all sitting next to each other. Paul, just picking up on the IHT review, does that at the moment sort of throw up any issues for par equity?
No, I mean, I think it's opportunity because we are sitting in there with, I mean, EIS portfolios that can be part of that discussion.
Yeah.
We also have a product in forestry, commercial forestry, which has always had an association with IHT planning and business property relief. And I think the interest in and the awareness of investors in that opportunity is actually much higher than it was before. And I think that's part of the debate that's been going on in public. One, inheritance tax as an issue is being discussed more.
Yeah.
But the longevity issues and the growth in population and the costs and how do you manage this intergenerational wealth. I think it's a debate that people are much more familiar with.
And just on the forestry side, because I've seen a few companies in this year, particularly in the last 12 months, begin to talk about some of the forestry opportunities again. I'm sort of showing my age. It feels like a long time since. I'm sure Terry Wogan had an investment in them donkeys years ago. What's appealing about forestry, and what are the sort of briefly what are the sort of tax benefits?
The tax benefits are legion, and that I think in many ways is what people were drawn to in the first place, which is that it is after 2 years inheritance tax free. All income generated from timber is tax free.
Yeah.
And it's only the underlying land asset that in fact really becomes chargeable. But I think the more interesting thing is once you get beyond the tax piece is actually the asset class has performed phenomenally well over the past 20 plus years. Its use in construction, the dynamics of importing and exporting timber, its increasing usage as a fuel has sort of underpinned the price in the market. And all of the forecasts would suggest that, I mean, our timber usage is going to increase and the value should increase with it.
And Dan, just as we wrap up this sort of little segment, we're at the start of the tax planning sort of segment. Would be one of your sort of general bits of advice, get in earlier. I mean, we sort of seem to be moving away from the sort of February, March tax rush. Okay. I guess you've been seeing probably quite good interest from advisors and their clients probably pretty much all the way through the summer.
Yeah, it has actually, and I think it's a sort of relief. I know that word gets used in many contexts.
No pun intended.
Yeah, but I think it's a relief that the industry is moving that way. It used to be this kind of like panic and and then fire, aim and fire, and now we've got the most certainly investment as well as interest and educational exchange happening over this summer. You know, nice hot summer, why would anyone do that? But people are really genuinely very interested. And of course that's prompted by legislative changes that are happening as a trigger. We have a quarterly, so we have an evergreen fund, our EIS and SCIS flagship funds, the Angel Plus, they're both evergreen. So it makes sense to us. Good business opportunities don't just happen in February and March. And I think if advisors understand, of course they understand that, if the market understands that more,
the clients understand that
exactly, and if clients can be persuaded, because ultimately it's not the advisors who are precipitating this mad rush, But it does show I don't think it's going to be a shift overnight like a nirvana moment, but it does seem to be that we've sort of broken that holy sacred cow of panic.
Super. Okay, we'll wrap up now, guys. Thank you very much.